Hey there, welcome to the channel. So today we're going to take a look at Carvana fundamentals. All right, so the first thing I wanted to kind of take a look at the chart where it's at. So we can see that Carvana here definitely was a high flyer. You know, this thing looks like it went public below $20 a share way back in 2017. And I'm going to be looking at financials from, I have the 2018 through 2021 financials, I believe, 4 years of yearly financials that I'll be looking at here. You can see that this thing kind of pretty much had a little bit of a crash there, but it basically had steady running up and then just kind of hyperbolic here in 2020 and 2021. But more recently, it's kind of getting the crap kicked out of it. It's back down below 100. So wonder what's going on with that. I think one more quick definition that we will see here is restricted cash. So restricted cash, this is from Investopedia. This refers to money that is held for a specific purpose and it's not available immediately or generate business use. And it's listed separately on the balance sheet. So if you have restricted cash, you'll see a cash equivalents, and then another line item for restricted cash. Now, the total cash is the sum of those two numbers. And you can imagine that, for example, you get a company gets a loan for $100 million to build a new store or something like that. Well, the lender might restrict the cash and say, look, it's this cash that way I lent you is specifically for this purpose. It's not for you to plug holes in your balance sheet and other things or other games or whatever. So that's the kind of thing that could be happening here with restricted cash. So that's just something that we will see in the balance sheet here. You have the balance sheet, which kind of lists all the assets and liabilities. And then you have the income statement, and this is going to show your revenue coming in and what that revenue cost. And then your cash flow, which is going to try to reconcile. You're going to reconcile where the cash went and where the cash came from in the business. And then the other statement would be owner's equity, where you kind of reconcile like how much is attributable to common, et cetera, et cetera. All right, so the first thing that we can note if we're looking at this is here we are on the income statement. And so we have our revenues. So our total revenues here, you can see are on row 13 here have been growing. So this is a high growth company. You know, they went from the 1.9 billion, 3.9, and they're up to 12.8 billion. And they also have it broken out by different categories. So you have your used vehicle, and then you have your wholesale, and then you have some other revenues. So you can see it's high growth. And what we can do is we can look at the horizontal analysis, and this will be comparison like, what did the used vehicle sales do from 2018 to 2019? Well, they grew by 91% here, then slowed down the growth to 38%, and then 107%. And then we can see here on the wholesale, growth of 262, 66, 300. And then overall for all the net sales and operating, you see, 100%, 41. So like they definitely had a slowdown in 2020, but overall they're kind of a high growth here, typically over 100% year over year growth in sales. So that's pretty impressive. Now, the other thing we can look at is a vertical analysis. So what we're going to do is we're trying to express our different line items as a percentage of the total sales. So this is the key number here that we have. So basically, I'm looking at, here's the 2021. So this is going to be expressing vertical analysis percent of this data here, right? And ditto for this and this. These guys are just for those particular years. So what you can see, if I take, and I'm going to show you the gross profit one. So I take my gross profit here of 1.9 billion, and I divide it by net sales, and that's going to give you the percentage of your sales, right? The percentage of your sales that represents your gross profit. And then you can do the same thing for your expenses. And then what this does is this helps you understand like, what is the gross margin? And you can see here that the gross margin has been improving. So what that means is that they were at like a 10% gross margin, and they've been eking this up to 15%. So that's going in the right direction. So understanding gross margin or gross profit, right? So it's gross profit is the number. Gross margin is what you call the percentage of your overall sales, right? And so, for example, if you had 10%, what would that mean? 10% gross margin. So what it means is if I sell a car for $10,000 and the car cost me $9,000, then what is my profit? $1,000, right? So what is that? That's 10%. Right. So I have a gross margin of 10%. Now, the way it works is that margin enough to cover my overhead? Right. So for example, I basically spent 9,000 to buy the car, sold it for 10,000, but that none of that includes what I'm paying for salespeople, buildings, rent, all these other things. That all gets included under SG&A, selling general administrative. So you need a high enough gross margin so that you can cover all your other expenses. If you don't, then you're going to have a loss. And that's what we see here. So for example, your SG&A as a percent of sales was 21%. Well, you only had 10% profit. So what do you get? You net out a loss, right? So 21%, 20%, 20%, and then they get this down to 15%. So, so this is really good trend, right? The gross margin is improving, the sales are improving. So this is all really good, right? Gross margin, sales improving. However, where they are at, they're still losing money, right? They've gotten this down to their net loss before income tax is only 2.2% of sales, which is good, but they're not there yet. So we can see over here that our net loss before income taxes, they're at 286 million. And then they have all this stuff to who is it attributed to? And then in a graph form, we can see it here, increasing sales, gross profit, et cetera. Okay, so the next thing to look at is because they have a loss, how are they supporting that loss, right? They lost $286 million in the year 2021. So we have to kind of figure out, well, is that okay? Did they have the money to lose that? Well, let's see. Let's go look at the balance sheet. Now, balance sheet over here, as we were talking about, you have a cash equivalents. They're at 403 million. Restricted cash at 233 million. So altogether, they got, $636 million in cash. And so the current assets, they have, a decent amount current assets and a decent amount of cash. However, and this is why I focus mostly on, there's a lot of information here, right? And there's a lot of stuff that I'm not familiar with. It leads can get very complicated, but in simply one of the main things, want to focus on is the cash. So this is like 403 million is all the cash that they have. So that how does this reconcile? Over here on your income statement, they lost $286 million. Well, did they have the 286 million to lose? Well, they had 403. Now, did they use up all that cash? Well, I don't think so. So let's look at the year before. So the year before, they lost $462 million. However, the year before, they still had 301 million in cash, right? So the point is that they have to have some other way to finance these losses until they can get the business to be profitable. So what do we do? Where can we figure that out? Well, cash flow. Let's go look at the cash flow statement. Okay, if we look at the cash flow, here you are. The way these statements start is you put the net loss up there or the gain, right? And now we're going to try to figure out where the cash came and went. So it's broken into three main sections. You have operating activities, and then what you have is investing activities, and then you have financing activities. So operating, you can take a look at a couple of things. So first of all, depreciation expense, this gets added back in. So for example, if you had a building and it was a $40 million building or something like that, and you were depreciating it over 40 years, right? And that means every year you have to take an expense of $1 million. So that $1 million would be included in this loss, right? But it's not a real cash expense. You didn't write $1 million for that depreciation, right? So you get to add it back in here. Now, this, because they're doing a lot of financing, it's a little more complicated. They are originating finance receivables, et cetera. Looks like they're maybe losing a little bit. And then inventory, right? So inventory will lower your cash usually, and this is actually changes. So the change in vehicle inventory is causing a loss here. So basically, in this particular case, because this is a negative number, they increase their inventory, right? Which makes sense. You need a certain amount of inventory to cover the size of the business that you have. So, inventory, you spend, in this case, $2 billion for cars. Your cash goes down by that $2 billion. So that's how it works out. But going down to the final thing, net cash used in operating. So for this last year, they used 2.5 billion. So not only did they lose 287 million here. They use 2.5 billion to run the business from the operating side. So let's look at the investing side. Okay, now these are investments that they make. Here we go, property, plant, and equipment. So they spent 557 million in cash on buildings, maybe those new fancy vending machine buildings and stuff. Well, so they altogether 627 million. So they used cash. Cash was spent on those things. Now we go down to the financing activities. So, okay, when you're looking at this, they have a loss here. They used money in operations. In other words, operations didn't bring money in, and then investing. They're investing in plant and equipment and stuff, and so they're spending more money on that. So it's got to come from somewhere. So they better be financing. So what you can see is like they have to get this money from financing, and here's where it happens. Proceeds from short-term revolving 14.6 billion. So these short-term facilities is where they're getting most of their money. And then payments on short-term, 12.5 billion. Proceeds from issuing long-term debt, 1.6 billion. So now you finally get a positive number. When it's all said and done, hey, they financed 3.5 billion net. And that's where they got the money. So you start out with cash from the previous year. So if you look here, cash 301, well, really, they're saying 307 here, close enough for government work. Okay, 307, cash equivalent, beginning of the period. I'm sorry. Yeah, at the beginning was the 329. So we can look at the balance sheet. The beginning of the period was 329. Yes, 329, right? They're not distinguishing, right? So 301 plus 28 is 329 million. So they put that down, 329. Then the net increase decrease 307 plus that because it was a positive. So they end up at the 636, which is, as I said, the total of these two values here. They're not distinguishing between restricted. So now what do we learn from this? What do we learn from this? We go back to the income statement. We see high growth company. Okay, good. We see a company whose gross margin is improving, going in the correct direction. So that's good. So in other words, you have a company that if they're able to grow and continue their trend of gross margin, they should turn profitable at some point, right? They're going in the right direction, unlike some other companies that we went through before. However, they're very reliant on financing right now, very reliant. Because look at this guy here, proceeds from short-term revolving facility. Short-term revolving, that my understanding is short-term finance is anything that is less than a year. So this means that this company is going out there and it's almost as if they're using a credit card, right? So they're buying inventory, they're buying cars and stuff like that. And they're not using long-term. They're not using debt that's due a year or later or 2 years or 5 years out. They're using money that like they need to pay within a year. So that's typically the line in the short term. So they're very reliant on short-term revolving, and revolving is kind of interesting, right? Revolving is what we have as credit cards, revolving debt. It tends to be at a higher rate. It tends to be, it's somewhat risky from the point of view that you're not getting a good rate, et cetera, and it's due right away. You keep paying on it right away. So that's really interesting. So this is maybe one of the downsides of this company. They're really dependent on short-term financing. Payments on short-term, 12.5 billion. Proceeds from it. Yeah, so you can see the difference there. And then now here they did issue some long-term debt, right? So basically what this means is they were able to issue some long-term debt. So ideally you would want a more stable situation. You would want to be like, hey, look, I need $10 billion over the next 10 years that I'm going to use to buy inventory or something like that. And I go issue long-term debt with fixed payments over the next 10 years for that. That would be ideal. And that's kind of the situation where maybe the long-term debt comes in and it's not all due. It's like, yes, I have to make payments this year, but it's not all due this year. Revolving short-term, it's all due this year. So they go ahead and they get 14.6 billion, and notice how they paid 12.5 billion in short-term. And that tells you exactly what's going on. They basically have to pay back that short term. So basically all this short term financing, they had to pay back almost all of it except for a couple billion. So if they get into, so here's where the downside is. This is where the issue comes in for the company. If they have a hiccup, if the cost, and we know the cost of this short term is going up. Interest rates are skyrocketing, right? You have the 10-year, right? The 10-year is pushing on the door at 3%. It's gone up from like, under 2%, like very quickly, right? So this is going up. So this means that this financing is going to cost even more money. And so this is the risk point for them. They are very reliable on short-term financing. And notice the long-term debt, they were only able to get 1.6 billion in long-term debt. Conceptually, you would look at that and say, well, would they have liked to replace some of this short-term 14 billion in debt with long-term debt to get more stability, especially maybe if they could fix in the rate or limit the rate? Right now, the short-term, your credit card is like, the rate just goes up. It just goes up whenever they feel like it. It could just follow the 10-year, as opposed to if you wrote a longer-term loan, a 5-year loan or a 10-year loan or something like that, where you can fix the rates better. Now, they would still have a variable, but you could limit the rate increases somewhat. So this is really the risk for the company. So basically, I'm looking at the company, high growth, margins going in the right direction. That looks good. Still has plenty of cash, 403 billion cash. But the problem is that they are so reliant on financing. Like if they screw this number up, if they screw up this financing, or this financing costs too much, or they're not able to get this financing, they're going to shut down really quick, right? This is the linchpin. This is the risk point for this company, as far as I see, that they are relying on the short-term financing to fund all their purchases. In many ways, it makes sense, right? You're just buying a used car from someone, and you're planning on selling it within a month or two, and so that's perfectly good. However, we can make an allegory here. We can kind of go, what was happening in Big Short? No, not The Big Short. We're going to look at the movie Margin Call. I don't know if you ever saw that. But Margin Call, what was happening there is in the company, and this was really happening in some of these financial companies in the financial crisis, is they were buying all these mortgages. And what they were doing is they were buying all these different mortgage-backed securities and these different securities, and they would bundle them together into a package, and then they would sell these off, and it would take time to do that. And so the idea was that, well, they were holding these. They don't want to hold them too long, but it would take time. So they would have to hold them for a couple of weeks to a month. This is what the issue becomes. If you end up holding the inventory longer, and you have to, and you like, for example, if you can't sell those cars, you spent $14 billion on cars, right? Short-term financing, 14 billion on cars, and you can't sell those cars, and you got to start paying that back without selling those cars, you're going to have a problem. And the problem that it's going to have is where it will show up. And so this would be the thing to watch. Now you start watching the gross margin, right? The gross profit and gross margin, because look at it. That's the first place that if there is a problem, and I'm not saying there is a problem, but if there is a problem, that's where it might show up. Because what's going to happen is they're going to be like, oh no, I got to pay this debt. The cost of the debt's going up. Like, remember, this debt over here, this is short-term stuff. This is going up with the 10-year, which is going through the roof. So what that means, I'm going to go back to the 10-year chart here. Yeah, so going back to the 10-year, this 10-year is spiking, like going through the roof, right? And so you can imagine how difficult it is for them to manage their business, where they're taking out short-term debt, using that debt. The debt may be like, the debt that they're using to buy the cars that they have to sell, the cost of that is going up. So once again, hey, I'm going to buy a car for $9,000. I'm going to go get a short-term loan for that, and I hope to sell it for $10,000 or $12,000. Okay, great. But if I have to hold it a little longer, if that slows down, they get stuck with the inventory. That's the risk that they have. And the other problem is that the cost of the money they use to buy that car went up. So right out of the gate, even if they keep the sales up and everything is fine and hunky-dory and there's no problems, they're still going to cut on their margin. So that's the first thing to watch. You go to the quarterlies, you now have an idea of what the gross margin is. You start seeing that margin drop off. That means that there was like, look, I got to cut the price of the car because I got to unload this car to get the cash to make my loan payment, right? They start getting in that kind of situation. That's where you probably will see it first. You'll see it on that margin side, because that's where they'll be like, and everything else will look fine. It'll be like, oh, we still have even higher sales. All this stuff will be great, but the margin's going down. And if that starts happening, which I don't know if it is, and I'm going to keep an eye for this, but if that starts happening, that's the first sign of the issue. Now, going back to the chart, Is that what the market's smelling here? You know, why does this company with 100% growth, like 100% growth in sales, why is this company gone in the last 6 to 7 months? Why has it gone from 360 all the way down to here to below 100? Well, I think the market's looking at exactly what I'm looking at. They're looking at it and saying, hey, look, we're going into recession. The Fed is raising rates. That will cause a recession. They can never get it right. And who's going to hurt? The consumer companies. You know, the car companies, car is the first thing that you give up. When you lose your job or you're struggling with high prices, you give up buying the car, even a used car. You give that up, right? You just like, okay, I just like spend some maintenance on the car that I have. I try to hold on to the car. You don't buy a new car. It's very cyclical. Car purchases are very cyclical. For you to commit to a car purchase, even a used car purchase, you know, you have to feel very secure in your job, and you have to feel secure that you have the money to pay for it. And with the current inflation, that even though the inflation may be peaking and everything like that, this is not an environment for that. So in addition to the fact that the rates are going up, so the profitability is going to get hit because the rates going up. Even if all the rest of the business is fine, they're going to take a hit to that profitability just from interest rates going up. And that, I think, is what the market is seeing. So that's it for this one. Not financial advice, but some things to look at. You're out there trading and buying this stuff. You can look at the fundamentals a little bit, and you could take a snapshot. You could just look at 1 year, look at the current year, do this vertical analysis, horizontal analysis, try to get that horizontal year over year. Everyone does that for you, right? Year over year, everyone does that for you because it always looks good with these high growth companies. So like, the growth, and that's what they always try to sell you. And that's fine. But you do that vertical, kind of express the expenses as a percentage of sales and see if that's holding the line. Is it getting better or not? And that can give you a sign where the issue is going to be. Now, that said, you got to look at the technical. See, I mean, that's the thing. Like, I'm talking about something that looking at numbers that haven't even changed yet, and the market has already cut the stock by more than half. Well, so that's why you have to trade. You don't trade fundamentals, you trade technicals. That's what it is, because this is figuring this out. These guys are already figuring this out. They're already making their bets. They already know what's going on. And by the time it shows up in the numbers, you've already lost 75% of the value of the stock. All right, that's it for this one. Talk to you later. Bye.